Well, let's continue that chat in the property sector, and particularly from a lending perspective. Anthony Landahl is now joining us from Equilibria Finance. Anthony, good to see you.
Great to be here.
All right, so we were just discussing there the risks that the IMF sees with the Australian property sector. I'm interested to get your perspective. There's certainly citing, I guess, just that high level of debt that Australians take on. Is that likely to dissipate, do you think, as we've seen those rates rise so rapidly? What is the appetite for taking on debt as far as buying a house at the moment is concerned?
Yeah, as Eliza was saying just then, our debt to income ratio is in terms of international standards, very high. And I think culturally for Australians, buying a home has always been high on the agenda. And obviously the last couple of years, that debt to income ratio has grown with the increase activity in the housing market, the growth we saw in the market, a lot of people borrowing to their capacity whilst essentially wages growth remained quite steady. What we have, I guess, seen of late is a fall in the market. We've seen a fall in credit flows, but I think that's just more in response to the environment we're in, the increase in interest rates. We haven't seen that housing market cliff, if you like. We're about 10% down on 12 months ago. A lot of the reason our market's remaining resilient, though, is probably related to factors outside of interest rates. It's more probably related to a falling supply, a fall in listings, as well as demand from immigration, a tight rental market. It's actually meaning some renters are now looking into the housing market. So whilst we have that high debt to income ratio and probably exacerbated by the last couple of years, our market to a certain extent remain resilient. In fact, as Eliza just said, in the March quarter we had growth nationally of 0.6%.
And of course, we've also seen the Reserve Bank pause this month, and that has led to speculation about whether we've seen a bottom in the market. What does that do, I guess, as far as the thinking of those looking to buy, their capacity to borrow, bearing in mind we are seeing a gradual deterioration in the economy? We're not saying recession necessarily, but the expectation that things are going to get tougher. Yeah. Perhaps we will start to see more job losses. What is that going to do as far as lending is concerned?
Yeah, I don't think the full effects of the monetary policy has flowed through the market yet, and it's probably been a little bit buffeted by reasonable savings buffers coming out of COVID, and also the fixed rates, which are now coming off. I think the fundamentals of the housing market remain pretty strong, but there's a lot more caution, I think, around whether we have hit the bottom of the market, whether it's on the rise. I think there is a cautionary approach because I think fundamentally people believe that there's a little bit more pain to come. The RBA is really focused on their inflationary targets. They're wanting to make sure inflation doesn't get entrenched in the marketplace. So the April numbers are going to be interesting. They come out in a couple of weeks. US inflation numbers indicated that the rate of growth in inflation, whilst it's slowing, there's probably still some rises over there as well. So I think it's a cautionary tale. I think the pause was welcome, but I think people are expecting a little bit more pain to come, to be frank, yeah.
How, and we talk about those, particularly those people who have a loan that are rolling off from fixed to variable. How are they negotiating that? Are you seeing a rise in that churn rate, I guess, where people are looking to refinance?
Yeah, it's a difficult environment. We're not so much seeing an increase in the churn because there are situations where people are physically unable to refinance because of the serviceability buffers. We haven't seen a lot of the negative equity as such. It's more been what you might have been able to borrow 3 years ago or 2 years ago, you're unable to get that to work now because of the new assessment rates, the rise in the interest rates. But I think in terms of the fixed rates, the majority of those are coming off over the next 3 to 6 months. I don't think we've seen the full impact of that. People are looking at what they can do. There's record refinancing in the marketplace, and I think that's only going to grow as people do come off those fixed rates and take a look at the market. And 25 or 50 basis points right now is not insignificant for a borrower in the market.
What's it going to take for the investor to get back into the market? It takes more than just a pause, doesn't it? Because there's still obviously those elevated rates. We've seen those rates rise so rapidly. And we've also, just speaking about the immigration rate that is lifted, so there is that demand there. That's attractive, clearly, for investors, particularly as the yields have risen. We know that rental story, it's so tight out there. But, I mean, is that really reflected in investor activity or not?
It's a really good question. I think we were sitting here a few months ago talking about there's some factors that are really coming to play that might favour investors. We were talking about the immigration increases over the next couple of years, the really tight vacancy rates in terms of the rental yields. I've looked into all of this a little bit more. There's two main factors that I think we can now identify that is exacerbating that investor pause. It's the cost to hold properties is going up. For example, whilst the rentals have been going up, on average they've gone up about $340 a month. With these increased rates, someone on a $500,000 loan as an investor, their actual repayments have gone up about $1,000 a month. So the cost to hold a property is outrunning the increase in the income. There's also additional cost to hold with potential maintenance and stuff like that generally comes in an inflationary environment. So we've had an increase in cost to hold, and secondly, it's more difficult to qualify for a loan. So for an investor looking for leverage, the value of their property may not have the same equity as 12 months ago. And secondly, some of the assessment rates, if you're an investor, your rate might be around about 6%. It might be being assessed at 9% now. So the cost to hold and the ability to qualify for a loan, as well as the uncertainty around the economy and the interest rates, we are seeing an extended pause in investor behaviour. Credit flows are down over 30%.
Is there any sign, we talk about potential distress with loans, any sign that investors are actually offloading their portfolios?
Look, there's some investors looking at restructuring, there's some investors looking at offloading, but there's other considerations for investors around capital gains, around is it the right time? It's a falling market. Fundamentally, it has been a falling market. Fundamentally, for an investor, now's a good time to buy as distinct from sell. So we're not seeing a lot of investors looking to offload unless they're in a situation where they might have a largest portfolio. They might have a home with some owner-occupier debt, and they essentially want to just deleverage a bit in this environment.
I guess it's also a question of whether there's actually the stock to buy. I was talking about, obviously that the fact that there's not a lot of stock on the market at the moment, and also you've got the paucity of new developments coming through. Yes,
that's right. Stock's an issue, and new developments, even some of the rent-to-buy schemes, they're all in the pipeline. They take time. But we are seeing reasonable auction clearance rates. Owner-occupiers are down, first home buyers are down. So for the investor with the ability to purchase, and if it's a good property and the fundamentals stack up and they can manage the cash flow in the short term, it is quite a good environment. However, there are those holding costs that are flowing through, and the qualifying costs that are impacting the market.